We've got Christy Mathai joining us from Quantum this afternoon to talk more about markets and the way they are approaching investing. Christy, afternoon. Thank you so much for your time. Where do you stand on that argument that Indian mid caps, small caps are way expensive right now, and it's the large caps which have more value? What are your thoughts there?
Right. Thanks, Ajay, for having me. So clearly, if you were to look at how the small and mid cap index have done post COVID, it has done phenomenally well, and especially last year. Last year was a combination of earnings growth plus the flows which came in a big way in the markets, especially in the small and mid cap segment, especially the small cap. Now, if you were to look at the various pockets within small cap, if you were to look any themes which are attached to the cap goods or investment theme, be it something around defense, be it construction, we find the market is fairly exuberant, especially in terms of valuations. So going forward, while that earnings growth that you saw this year may come off a bit because some of the margin improvement were kind of due to some commodity deflation and so on and so forth. So there could be some earnings impact coming next year, and especially with the recent noise around flows, if the flows were to moderate, we can see some bit more correction, be it time or price, that's anybody's guess. So this pocket looks expensive to us, and we are very fairly cautious on this part of the segment.
Okay. What are your thoughts on the fact that the earnings upgrades the quarter gone by were one of the lowest in the last several quarters, and the earnings quality actually appeared good because of margin improvement. The revenue part of bulk of corporate India was actually on the slower growth. Does that worry you?
Right. So we think Indian economy post COVID we have seen dramatic improvements in earnings, and mostly consensus have upgraded their numbers with each passing quarter. And last quarter, if you were to broadly see it, or the near term, it has been fairly driven by margins. So in a sense, the top line growth has come off in certain subsegments, but we don't think that is necessarily a risk. It is probably the impact is more from a base impact perspective, where we have had previous year or quarter operating from a very high base. So that is fine. I don't think that is a major reason for worry. So, but going forward, we should see some moderation in margins also, because as I said, some of this were commodity linked, and there have been fair bit of passing on the cost to end consumers in the form of price hikes. If you were to see the whole consumer discretionary pack, especially the autos, that is what has happened. Now it is very pivotal that going forward you should see that volume recovery in some of these pockets, and if that were not to happen, then that would be concerning. But as of now, we are fine with how the earnings trajectory is panning out.
The portfolio which you have shared with us uh, at Quantum EMC, long term equity value fund, what is the kind of earnings growth visibility of your fund right now and versus the valuation it is trading at?
Right. So we are somewhere looking at around 13%, 12 to 13% earnings growth into FY25, and the valuations in the market cap that we operate, which is fairly large and liquid, are probably on the higher side than what we have seen historically. So that caps a lot of upside potential in most of our stocks that we look at. And because of that, that is the primary reason why we are a bit cautious on the market going forward.
Christy, my view is that I want to understand if the broader market does offer a correction in the last 1 or 2 months, which are the areas which you have on your radar to add positions into?
Right. So, if you clearly see, what offers value to us currently is banks, especially the private sector banks. We have invested quite a bit heavily, and we think even if there is more correction, we would love to add to some of these pockets. So, some of the consumption-linked themes, be it FMCG, certain in consumer discretionary, we think are fairly bit away. Even with some correction, we don't think they would come to our buy price, in the sense if you were to look at stocks. So even going forward, we would look to add more into some of these pockets where valuations have been reasonable, be it banks, be it consumer discretionary, especially autos. What we have seen is in the past 2 years back, we have added quite aggressively in the two-wheel volume names. But now, hoping for a replacement demand to kick in, and in the last 9 months, we are seeing some bit of that happening, and that has led to some bit of exuberance on valuation. So if there is some correction in this pocket, we would love to add to that particular pocket, as well as durables also some of the areas where we are looking to add, because the whole competitive intensity has been very high in that whole segment, and going forward possibly there can be some breather that is coming through, but these are fairly long term structural trends in the Indian economy. So these are some of the pockets where we would be looking out, to add going forward as well.
All right, Christy, we'll let you go on that one. Thanks so much for joining us on the show today.
If you like this video, then like, share and subscribe to ET Now.